The 60 days before you click submit on a funding application matter more than everything you did in the past 2 years. Most business owners spend that window destroying their own approval. My name is Justin. I'm not your typical CPA. I focus on business growth and finance. Let's go. So here's the big picture. Right now, today, the lender you're about to apply to is not waiting for your application. They are building a picture of you. Every deposit pattern, every credit inquiry, every utilization spike, every overdraft, every address change. When you finally hit submit, they don't start evaluating you, they finish evaluating you. And the 60 days you just lived, that's the tape that they are reviewing. Today, I'm showing you exactly what's on that tape and what you need to stop doing right now before you apply for a single dollar. Here's the move most people make. They decide they want funding. They spend 2 weeks getting their documents together. They fill out the application really carefully. They hit submit, feeling like they did everything right. The bank, however, already made their decision 3 weeks earlier because of something you did at the beginning of last month, something you thought was smart, something nobody told you was a red flag. You see, you spent 14 hours filling out that application perfectly. They spent 14 seconds reviewing the bank statements from 60 days ago and said no before a human ever even opened or looked at your file. That's what this video is. Consider it the memo the bank never sent you. So here's the machine reviewing you right now. In 2026, the majority of lenders now use AI underwriting as their first filter, not a loan officer, not a banker, an algorithm that flags behavioral patterns before a human ever sees your name. The SBA just changed the rules on its $30 billion loan program without public announcement. The goalpost moved quietly. 80% of financial risk leaders say fraud attempts are increasing over year, which means AI systems are more aggressive, more suspicious, and flagging more normal looking behavior than ever before. This is the reality that we live in today. This is not a conspiracy theory. This is the reality of the 2026 lending environment. The machine is looking for patterns that match fraud and default risk. Some of what you think is good hustle looks like a red flag to the algorithm. So let's talk about exactly what triggers it. There are 6 behaviors, the 60-day window. Make sure to write these down. Number 6, you're spiking your credit utilization right before you apply. You got a new contract coming in, business is picking up. You put some expenses on your business credit card. Maybe you even max it out a little, thinking you'll pay it off when that loan comes through. Here's what the underwriting AI sees: a sudden spike in your credit utilization in the 30 days before your application. That pattern, low utilization for months, and then a spike right before applying, it's one of the top red flags for default risk. So here's the rule: keep business credit card utilization under 30% for at least 90 days before applying, ideally under 10%. Utilization spikes are weighted more heavily than your score in many AI underwriting models because they signal financial stress, not financial health. The math is brutal. Your score could be 720 and a utilization spike in month 2 or 3-month look back period can still trigger a red flag that influences the decision of your loan. Number 5, you made large deposits right before applying. You had a good month, a client paid you a big invoice, you deposited $40,000 into your business account the week before you applied. That's great, right? Not to the AI. A large, unusual deposit that doesn't match your 60-day pattern is one of the most common fraud flags in modern underwriting. It looks like manufactured cash flow. Banks call it deposit padding. They've seen it 1,000 times. So the rule: your bank statement needs to show consistent, recurring revenue, not one large spike. If you had a big deposit coming in, let it season for at least 60 to 90 days before applying. Now, here's an interesting statistic. Over 60% of flagged small business loan applications involve cash flow that doesn't match the stated revenue pattern. Remember that. So you did everything right. You did it just at the wrong time. That's not a credit problem. That's a timing problem. And timing is fixable. Number four, you closed old accounts to clean up your credit. This one makes me feel protective every time I see it. Someone reads that they should simplify their credit profile before applying. So they close 2 to 3 old accounts, cards they weren't using, vendor accounts, old lines. They think they're cleaning house. What they actually did, they just shortened their average credit history age, and they erased years of on time payment history. This is a bad thing. Now, your score dropped sometimes 30 to 50 points. It could drop 30 to 50 points right before applying. So here's the rule: do not close any credit accounts in the 90 days before applying, especially not old ones. Old accounts are proof of longevity, and lenders, they love them. I talked to a business owner recently who had a 710 credit score. She closed 3 old cards before a credit tip on social media told her to. Now, she applied for funding with a 668. So that 42-point drop, it cost her the approval she needed. And she let that misinformation be the reason that she did not get qualified for the loan. Don't be this person. Number three, you applied somewhere else first and got denied. Here's the trap nobody talks about. You apply somewhere, you get denied, and then you think, let me try a different lender. But the first denial left a hard inquiry on your report. And the second lender's AI system, they're going to see that you were recently denied and you're trying to apply again. This makes you look desperate. This pattern, multiple applications, recent denial, it's a huge risk signal. You didn't get denied twice because you had bad credit. You got denied twice because the first denial made the second one more likely. So here's the rule: soft pull your business credit profile on nav.com before any lender touches it. Know what they'll see, know what's there. And then once you know what's there, apply to the right lender with a complete file. Stop spray and praying your application all over the place. It's not persistence, it's compounding your rejection. So business lenders, they typically flag 3+ hard inquiries in the prior 90 days as a risk pattern. 6+ inquiries in 180 days is an automatic review flag at many institutions. Remember those metrics. Number two, your bank statement shows overdraft or negative days. This one is quiet. You might not even remember it happened, but 60 days ago, your account dipped negative for 2 days before a deposit cleared. Or you had a $12 overdraft fee. That's on your bank statement, and underwriters, human and IA, they look at every month of the look back period for negative balance days. Even one overdraft in a 90-day statement period can trigger a manual review. 2 or more, that's often an automatic decline at traditional banks. So here's the rule: set up overdraft protection on your business account today. Maintain a minimum balance buffer, even $500 at all times in the 90-day pre application window. Here's an underwriter reality: lenders are trained to look for NSF, those are non sufficient funds. They're markers on bank statements. NSF, it equals a high risk borrower signal in every underwriting model. This is not good. A $12 overdraft fee from a day you forgot about may cost you $75,000 line of credit approval. This is the most expensive $12 in business history. Don't be this person. And number one, you change your business information right before applying. This is the one nobody talks about. This is the number one stealth killer. And it's almost always done with good intention. You finally update your business address, you change your registered agent, You update your phone on Google, maybe you file an amendment to your LLC, and then you apply to the AI underwriting system. A business that suddenly changes its address, contact information, or registered agent in the 30 to 60 days before applying matches a fraud pattern. Not because you're committing fraud, because fraudsters do exactly this to create fake business profiles before applying. So remember, the timing is everything. The change itself is fine. Doing it right before you apply, that's going to throw up a red flag. So here's the rule. When you make any business information change, make sure you wait at least 90 days before applying. Let the information age and appear consistent across all platforms before the lender pulls your business profile. Now, here's an AI fact. Modern underwriting AI cross-references your application address with your DUNS profile, your state filing records, your bank account address, and your Google business listing automatically. Any mismatch or recent change triggers an automatic review. So the irony is real. Cleaning up your business information, it's the right move. The wrong time looks like you're trying to hide something. Remember, timing is the strategy. So here's the bigger picture, and this is what's really happening right now in April 2026. The SBA quietly changed the rules on their $30 billion lending program. AI is now the first reviewer for most lenders. Fraud attempts are at an all-time high, which means the systems built to look out for more suspicion. The black entrepreneur in Memphis who is trying to build something, the real Latina business owner in Phoenix who's been grinding for years, the veteran who came home and bet everything on the business idea. They're all being run through the same algorithm. The algorithm doesn't know their story, it only knows their patterns. The difference today between the person who gets funding and the person who doesn't in 2026, it's not talent, it's not business plan, it's not even credit anymore. It's a pattern awareness, knowing what the machine is looking for before the machine looks. Now, I've said this before and I'll keep saying it. I talk to business owners every week who have built something real and they've done everything right and they still get denied because of something they didn't know. Today, that's one less reason. You're not behind. You're just missing information. And the problem, we just solved it. So write this down. The 60 days before you apply for the application, that's the most important 60 days. And start treating them that way. Now you know what not to do in the 60 days before you apply. But what should you actually be doing in that window to maximize your approval odds? Now, I've built a full pre-application checklist, every positive step to take in order in the 90 days leading up to your application. I cover it in the video right here. Watch it next. It picks up exactly where this one ends. So now you know exactly what lenders are looking at in the previous 60 to 90 days leading up to your application date, and you understand the behaviors that are involved and what not to do so that you don't get denied. So if you've gotten any value from this video, leave a fire emoji in the chat. Leave that fire emoji in the chat. And don't forget to hit that like button, smash that subscribe button, and leave a comment so we can get this video out to more people to your success. Salud.